Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Welcome to the Global View on this Friday. Well, global small caps have struggled over the course of the aggressive monetary tightening cycle from central banks. Higher borrowing costs have hurt growth, but is that tide now turning? And do small cap valuations now look attractive? Well, American Century Senior Portfolio Manager of Global Small Caps, Trevor Gurwich, is in Australia, and for his outlook, I caught up with him earlier.
Global small caps have, over the last 12 to 18 months, had quite a large sell-off. In fact, they're trading now at a significant discount to larger caps globally, despite the fact that you're getting significantly higher growth, almost 22% forecasted consensus growth for next year, versus the large cap universe at about 12 or 13% growth. And you're now paying about 12 or 13 times earnings for that growth. That gives you extremely attractive risk-reward dynamics in the asset class. But the issue right now is the market's very focused on inflation. They're very focused on rates, the direction of rates. And I think that's ultimately what's going to be driving things going forward for the next few months.
Are you seeing a change, particularly as far as investor behaviour is concerned? What sentiment is out there at the moment, with perhaps the likelihood where certainly near the end, if not at the end of the rate hiking cycle, is that now perhaps, are you seeing the tide turn, particularly in the small sector?
So what we're seeing is the market trading in a very range-bound motion, really channeling between zigzag movements on expectations of, are we getting further rate hikes, or are we getting to that end of that rate hike cycle? What we are seeing is that as the economy shows that it's actually not slowing down as much as people are expecting, there's expectation for further rate hikes by the Fed, which then creates more of a risk-off type of trade, more of a trade towards the value, deep value sectors versus the growthier sectors. So what we really need to see is we need to understand where the growth cycle is, where the inflation cycle is, and get a better understanding, are we closer to the end of those rate hikes, or do we still have some more to go? So while 2022 was the real big question mark as to how many rate hikes are we going to get, how long are those rate hikes going to go up, I think 23 is a question of when is that last one or two hike going to be put in place, and then how long are those rate hikes going to stay in place, or those higher rate levels staying in place.
We only have to look at those where those treasury yields are at the moment. Market essentially taking the bet that rates will stay elevated for an extended period of time. Given that, what is the outlook then? If we take a look across the next 6 to 12 months in the small caps globally, what's your outlook?
So again, I think that once we get that rate stabilization, companies will be able to understand what their true cost of capital is. They'll be able to make those budgeting decisions, and they'll be able to go ahead and plan with a new normal in place. And I do think at that point, what you'll start to see is the companies that are able to grow in that environment, companies with pricing power, companies that have a balance sheet to make acquisitions, will then start to lead the pack.
Can you do this on a sector basis, or is this a stock by stock pick?
Well, you do stock by stock picks by sector. So there are certainly opportunities in all sectors globally right now, and that's what makes the small cap and the global small cap universe very special, because you do have a lot of sector opportunities, whether it's in the Asian travel reopening theme. We're seeing a lot of opportunities there, whether it's companies like Samsonite, which are selling luggage, whether it's a Samsonite, Delsey, American Tourist, or the Tumi brand. They're seeing very healthy appetite for new suitcases as people want to embark on new travels and journeys. In Japan, we just saw the reopening of Japan about 12 months ago, and we are starting to see planes arriving in Japan, foreign tourists arriving in Japan, a lot more shopping going on at some of the local Japanese stores. We started to just see the emergence of the China group travel going to Japan. So those are the types of themes that you are finding, and I think those themes will predominate despite high rates next year.
Is that based on perhaps, we've seen a lot of the luxury brands doing very well. We are seeing consumer spending come off, of course, in the face of rising interest rates and cost of living pressures. Is that where you'd be focused on at that higher end, particularly as far as consumer-facing stocks are concerned?
So what we're seeing is that consumers still want to get that experience. They're looking to get out and try new things, not necessarily to buy the next luxury pair of shoes or handbags, but to get out, travel, especially the Chinese that have been locked up in their hometowns for much longer. They are developing that appetite to want to go out and experience things. And I think experiential travel is an area where we see still pretty strong demand globally.
Talking of China then, do you have your reservations there? Obviously, given what's going on with the broader economy and the slowdown there and frustration perhaps in markets that are not seeing greater stimulus, how does that affect your investment view, particularly in small caps?
Mm-hmm. So in terms of just consumer demand in China, we are seeing quite a bit of weakness. In terms of the real estate sector, we're seeing quite a bit of weakness. We also are seeing quite a few firms, looking to take investments out of China and diversify to start reshoring globally. An example for us is an investment we've made in a Mexican company called Vestas or Vesta. It's basically a warehouse REIT or a company that develops the places where companies that want to reshore want to go in Mexico to be closer to NAFTA. So we are definitely seeing capital being taken out of China. However, one has to keep one eye open on China because it is a very large economy. They will grow over time, and there are a lot of opportunities that will emerge, especially given the valuations that are really starting to look very tempting right now.
Trevor, let's focus on the States, and of course the story this year has been those mega cap tech stocks, the so-called Magnificent Seven, and we've seen some dramatic growth there. So as the investors and the markets are focused on that area, what's been happening at the smaller end then?
So what we've seen is just dramatic discounting of the small cap space, despite pretty attractive valuations and pretty attractive growth rates of companies. Most of the focus, most of the money flow has gone to the large cap space. So when you take a look at the growth area that's been rewarded, it's really been rewarded mainly to the large cap names. The mid cap, the small cap, and the micro cap space has completely been neglected from that aspect. So my expectation is when things again normalize, there'll be more focus, there'll be more of a spotlight put on companies where you're seeing price to earnings growth ratios being extremely attractive, 0.6, 0.7, 0.8 times price earnings to growth, which is, anything below 1 is generally a pretty attractive opportunity.
Are there any particular sectors you'd be focused on where you're seeing good valuations at the moment?
Now, we do like technology within small cap, certain areas that are focused on AI, but not necessarily NVIDIA, which is now a huge mega cap, hugely expensive, but companies that are providing services to NVIDIA, whether it's the optical inspection of the chips that go into the NVIDIA products, whether it's beneficiaries ultimately of what will happen, we believe, with artificial intelligence. So one of the areas that we think is a real beneficiary is cybersecurity. Businesses like Tenable or CyberArk, which is actually based out of Israel, those types of businesses will be direct beneficiaries of AI, which we think will ultimately be a vehicle that malevolent actors might use to try and penetrate corporate networks, and we will need to continue to see more defense mechanisms and more software companies going ahead and providing that support.
Is there a need to be cautious when you're looking at AI? There's been so much hype attached to it. We know the potential there, or perhaps we're only just becoming aware of that. Yet, perhaps cynically, we see some companies simply attaching AI to their name or mentioning that as they try to entice investors.
Right. Well, we really try avoid the price to buzzword multiple. And we try and focus on where is the business actually seeing the revenue growth, where are they seeing the earnings growth? Because ultimately when we invest, we believe earnings drive stock prices. And we believe that the market's inefficient at identifying the inflection points of the smaller cap companies because of the less coverage they're getting from analysts. So when we're looking at the beneficiaries of AI, it's actually companies that are getting revenues today or are seeing improved pipelines today from what's going on right now. So it could be a server company likeYwin in Taiwan that makes white box servers that is getting pretty large orders and seeing their backlog swell because companies are investing right now to generate the environment to power AI.
Trevor Gurwich, American Century's Senior Portfolio Manager of Global Small Caps. That is the Global View on this Friday. We'll do it all again on Monday. Stay with us. The Open is next.